So the S&P 500 index in the last couple of weeks has been teasing its 200-day moving average. A lot of investors use that as a long-term barometer, an overall sense of the broader trend. We can also use it as a breadth indicator, and I would argue that the percent of stocks above their 200-day moving average may be the most important chart to watch now for the S&P 500. So there are a number of measures of market breadth, which is basically another way to say participation. When we look at a broad index, the S&P 500, the NASDAQ, the Russell 2000, we see it doing a certain thing. Breadth indicators tell us about the individual stocks that comprise those indexes, right? Out of the S&P 500, those 500 stocks, what are they doing relative to the broad index? Because a lot of times what happens during the end of a bull market phase, for example, is you will have the price of the index go higher, but the breadth indicators start to roll over. That's something we've seen in the US markets starting in November, December into January. Saw breadth deterioration as breadth indicators got weaker. Other videos on my channel here address that particular weakening breadth situation that we've been seeing in recent months. Today we're actually going to look at one particular indicator, the percent of stocks above their 200-day moving average. I would argue this is a key chart to watch now because it can help you differentiate between a short-term pullback and a long-term corrective pattern. Before we get to the chart, if you like this sort of thinking about investor decision-making using technical analysis and behavioral finance, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We very much appreciate that back. Put a comment below. What do you see for the S&P 500? Does the next 10% move higher or lower? Let me know in the comments below. Let's get to the chart. Okay, so here we're looking at the S&P 500 over the last 2 years, just open, high, low, close with the 50-day in pink, the 200-day moving average in red. First panel below the price is the percent of S&P 500 members that are above their 200-day moving average. So the S&P 500, as we're recording this, is literally right at its 200-day moving average, but recently has swung just below. Before that was just above there. This indicator looks at all 500 members of the S&P, and it's basically what percent of them are currently above their 200-day moving average. At the bottom, it's the percent of stocks above their 50-day moving average. We're not going to talk a lot about this series in this particular video. Other videos on my channel, we dig into that a little bit more. It's a little more of a short-term gauge of participation. We're going to look at this section here, which is the percent of stocks above their 200 days. So first observation, look back here in April of 2021, it was over 95% of S&P 500 members were trading above their 200-day. Currently, it's around 45%. I have this red arrow showing you how you had this deterioration in the indicator. So every month, the S&P was making new all-time highs, but there were less and less stocks above their 200-day moving average. Over the summer last year, this was one of the things that started to tell us that we were nearing the later stages, most likely, of a bull market phase, because even though the S&P was remaining well above its 200-day moving average, a lot of individual stocks were actually already starting to break down and were unable to regain their 200-day moving average when the market was pushing to new highs. Now, all of a sudden, we've broken below 50%. You can see it doesn't happen that often, particularly over the last 18 months. It's not happened at all. The last time we were below this 50% line, where over half of the S&P members were below their 200-day moving average, was back here in the first half of 2020. We first dipped below there in February of 2020, stayed below there for quite some time, almost 3 months. Bounced above it in June and then went right back below it and then finally cleared it and remained above there. And that was one of the indications that overall the market was in a decent structure. When you had a big sell-off, this indicator getting back above 50% is usually a sort of all clear signal, which tells you that there's enough underlying strength. Most likely the market can go higher from here. So what does it mean that the indicator is at 45%? Well, it makes sense because the S&P itself has been trading right around its 200-day moving average for the last month, really, after that initial pullback in January of this year. And you can see the indicator has gone down right to the 50% line. So it's literally 50-50. Half of the S&P members are above the 50-day, half are below. Here's the kicker. Let's look at a little bit more history. So now we're doing that same chart, daily chart, but we're going back to the low in March of 2009. I've highlighted in these purple shaded areas the 5 previous times since the 2009 low when we've gone below 50%, and we've remained below there for a little bit of time. There have been a couple times here in 2012, once in 2014, where we dipped below it briefly and then came right back above, and those ended up being fairly buyable dips in the market. But if you look, when we got pretty far down, if we got below, let's say 30%, If we remained below there for an extended period of time, you can see that this lines up with basically the major market pullbacks going back to the 2009 low. And what's interesting is if you look at the beginning of this shaded area, when we first went below the 50% line, that was really the beginning of these corrective periods, right? We hadn't come off that much before that was triggered. It was sort of initially rolled over. You can see that goes below 50%, but that's when the real pain began. And it was not just in terms of price, even though we made lower lows after that signal in every one of these situations. So to be clear, we first went below 50%, and then later we actually made a new price low, which is interesting to think about right now as we're dipping below 50% yet again. But also look how much time it took for the bull market phase to be regained. So in every one of these situations, we had a lower low in price, but eventually we made a new high, right? And we continued the bull market phase. But in every one of these times, at the least, it took about 6 months. At the most, it took even more than that, right? It took about 6 to 9 months to recover the previous highs and resume the uptrend for when the indicator finally got it back above 50% and the price was an all clear. So what concerns me about this current environment is now that we've even touched the 50% level, we're putting it into a relatively low number of observations. And most of the times, even when we've just touched 50%, it's ended up being a longer, more protracted corrective period. 5 of these times when we've broken below 50% and kept going, or when we've remained below 50%, these have been the deeper corrections. These have been the times when the market has been in a corrective period for quite some time, and there's been a meaningful bottom that has occurred there. So what does this overall tell me? It tells me the longer we remain below 50% on this indicator, when less than half of the S&P members are above the 200-day, the longer we remain below 50%, the more and more it looks like some of these deeper corrective periods. And in every one of these times, we've made a higher price low. So that tells me we remain below 50%. I should expect 2 things. Number 1, the low is not in. We should expect a lower low in price before this corrective period is over. And number 2, we should buckle up for a more of a longer time frame in a corrective pattern, even though there could be some choppiness. And you can see some of these, just more of a choppy sideways period, but it was more of a corrective period, right? The market really didn't have any upside gains for a number of months. So that's why I would argue this is one of the most important charts to watch right now. So there you go. When you look back at market history, particularly back to the 2009 market low, you can see it's pretty rare that we get below 50% on this particular indicator, less than half of the S&P members above their 200-day moving averages. What concerns me is this is starting to look more and more like some of those deeper corrections. The 5 major corrective patterns going back to 2009 have all had this beginning where there's an initial sell-off, the indicator goes below 50%, and in every one of those times, we have eventually made a lower low before the corrective pattern is over. I would be watching this to see if we remain below 50%. That should tell you to think, I would argue, more and more on the side of caution, on the side of risk management, as opposed to thinking of this as a buyable dip. What do you think about this sort of analysis of price behavior and investor behavior using charts and technical analysis? If you're on board with it, please subscribe to my channel. It'd be great to have you on along this ride with me. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment in the comments below. Do you think the next 10% move in the S&P is higher or lower, and why? Let me know. From Market Misbehavior, I'm Dave Keller. Stay safe, be well. Talk to you again soon.